All right, what's up, everyone? Welcome back to Investing Sucks. So today I'm going to be doing a little bit of a different style of video. I'm going to be talking about the weed industry and specifically taking a look at Canopy Growth. Now, if you guys remember, back in the year 2018, the Canadian federal government legalized recreational marijuana use. And with that came the so-called green rush, where investors became very, very optimistic about the future of this completely brand new industry. And as a result, companies like Canopy Growth really started to take off. And as we can see from this company's stock chart here, we can see pretty much as soon as 2018 rolled around, it had a huge run up. And again, it had another run up in early 2021 when there was some news of new legislation coming out regarding legalization of marijuana use. So at its peak, it was about a $20 billion company, 20 billion in Canadian dollars. And around the time it was a $20 billion company, it was only doing about $250 million in sales. So at that point, the company is trading about an 80 times price to sales ratio. Now, some of the fastest growing, most promising technology companies in the world don't even have price to sales ratio that high, let alone a company that sells actual physical products and has to carry inventory and has to reinvest back in the business in order to grow its operations into the future, which is what's necessary in order to justify a price to sales ratio that high, let alone a company that is in a completely new brand new industry where the prospects are still very unknown and there's many unanswered questions regarding things like what future legislation would be enacted, what customers' taste would be, how many people would actually be interested in buying those products. So what I wanted to do in this video, again, it's a different style of video, is just talk about kind of why this happened, why we tend to see speculative bubbles like this happen, and also what us as investors can do to protect ourselves from these situations and avoid losing money. So if we fast forward to today, we can see that Canopy Growth is still reporting very high operating losses. So we can take a look at their net income here and we can see this is in billions of dollars. And each year they're losing several billions of dollars. And if we scroll down here and we look at their margins, we can see in some years, so 2020, their gross margin has actually been negative, which means for each dollar of products they're selling, they're not even generating enough revenue to cover the cost of the product itself, let alone all their operating costs, which is why you see such a negative gross margin and such a negative net margin as well. Now, one thing that's always important to remember as an investor is that the only reason that any business out there has any value is because it's assumed that one day they will be able to generate positive cash flows. The intrinsic value of a business is just the sum of the present value of all the future cash flows that that business is going to generate from now until the end of the time, discounted at your given rate of return, which could be usually somewhere in the range of 10 to 15%. So when you see a company that has a market cap that's fluctuating as much as a company like Canopy Growth, you can clearly tell it's due to very rapidly changing perceptions about what the future of those cash flows will end up looking, what the future cash flow generating potential of the company is. And the issue that you have with companies that are operating in completely brand new industries like the marijuana industry was in 2018 is there's no reliable data to go off of. What you're trying to do is you're trying to judge a situation that's essentially impossible because there's so much uncertainty surrounding it. You don't know what new legislation will be enacted, what customer taste would be, whether they'll actually like the products that the company is offering. Now, what I want to do is compare the so-called green rush, which refers to the big run-up that not just Canopy Growth, but a lot of weed stocks had, to other speculative manias in the past. So what you're looking at here is historical data relating to the NASDAQ. Now, the NASDAQ is known for being very tech-weighted. So a lot of the technology companies you're going to find in the NASDAQ. So if we're looking at the history, really, it kind of looks like there's just this run up and this just little blip, and then ultimately ended up recovering quite nicely, and especially in recent years has gone up quite a lot. But if you actually take a look at what happened here, we can see in early 2000, it was about the 4,000, 4,300 level. It fell and it didn't reach that for another 15 years. It took all those 15 years just to recoup your initial investment. And it's very easy to look at this in hindsight. We all know why this happened. It was due to the dot-com internet stock bubble of the late 1990s. It's very easy to look at this and just say, wow, look how stupid people were. How could people have possibly been buying these companies up at these prices, at these such high valuations? But what you have to understand is the only reason that that happens is if the general sentiment towards those companies is that they're going to be fabulously successful. So unless you're someone who defies conventional thinking right now, then you can't really say with certainty that you would have defied the conventional thinking back then and you would have completely avoided the internet stock bubble, because you have the benefit of hindsight right now. It's very easy to look back at that and say, you know, people obviously didn't know what they were doing. They were delusional. That's never going to happen again. That's not me, because something like that could be happening now and we just don't realize it. And it's similar to what happened with weed stocks, because the internet back in the year 2000 was this brand new phenomenon. Investors really had no idea what they were dealing with or how to accurately assess the value of these companies. They didn't know what the value of the internet was. And it's a common thing to just be very optimistic towards it, even when you can't really foresee what challenges will come. And I don't think anyone would deny the fact that the internet ended up changing the world. It changed business. It really changed everything. But even though that happened, still a lot of people lost money by making ill-advised bets. So the same thing can happen in the weed industry. And even though there's still time left in the weed industry, I'm not declaring it a failure yet. You can't deny the fact that the challenges it has faced have been quite strong. Now, what I also want to do is compare this phenomenon that I've been talking about to something that we're actually seeing right now. And I've got the historical price of Bitcoin pulled up on the screen here. It's a very similar phenomenon that what we're seeing with cryptocurrencies, not just Bitcoin, but cryptocurrencies in general. Now, everyone knows these tend to fluctuate a lot. And the reason it fluctuates a lot is because investors really don't know how to accurately assess the value of one Bitcoin, because it's dependent on so many different things. And, whatever's going on in the news could drastically alter the price of Bitcoin because it alters investor sentiment. Now, personally, I don't doubt that blockchain technology is going to completely change the world 20 years from now. It's very powerful technology, and I think it's only a matter of time before that happens. But that doesn't mean that any cryptocurrency out there is going to be extremely valuable into the future just because it utilizes blockchain technology. It's the exact same thing we saw with internet stocks, and it's the exact same thing that we saw with the weed industry. And again, the issues with cryptocurrencies is they're just so new. People don't know how to accurately assess the value of it because it's something that's completely new. And it's just so uncertain as to what's going to happen in the future to make a judgment on what the actual price of one is. And I'm not saying this to put this doomsday prediction out there and say every cryptocurrency is going to go to zero, because that's not what I'm saying. But I think it is safe to say that with thousands and thousands of cryptocurrencies having been already created, most of them will probably be worth nothing 10, 20 years from now. So where am I going with this? How does all this relate to weed stocks and more specifically Canopy in terms of what's actually going on now? Well, when the Canadian government legalized weed in the year 2018, as I talked about, it created this brand new industry that was so new, investors could not accurately assess its potential. And thus, they couldn't really properly value the companies because there are just so many possibilities, right? Weed could have become this huge industry similar to what happened with alcohol in the years following Prohibition, or it could have just never taken off and people would just keep buying pot illegally because it's ultimately cheaper, right? There are many unknowns, and there still are many unknowns, such as what US jurisdictions are going to legalize weed into the future. In what capacity will they legalize weed? Would it just be, recreational use or medical use, whatever the case may be? And how much of that market will a company like Canopy actually end up capturing? So all those things are outside of an investor's control. But what is within the investor's control, which is something that we do a lot of on this channel, and that's to determine what future scenarios of company fundamentals, revenue, earnings, and free cash flows could actually happen given future outcomes, and what our return on our investment would be under each of those scenarios, and then try and decide what we actually think will happen, what's the most likely thing to occur, and how much risk are we willing to take on. Now, doing this is actually extremely difficult because how much money a company like Canopy could make in the future depends on many things we discuss, but one of the biggest one is what US jurisdictions actually end up legalizing marijuana use. Because that's really what you're looking for. You're looking for regulatory approval and Canopy getting these licenses and certifications, which would allow them to expand into those new markets. And as it stands right now, as you can see, as I got pulled up on the screen here, we have 18 US states that have fully legalized all forms of marijuana use, and then various other states that have legalized certain parts, for example, recreational use, or some states that have it banned just altogether. So if it was the year 2018 and you were looking at Canopy, you'd probably be thinking, Well, it really just comes down to what states or other jurisdictions end up legalizing marijuana, because however much weed these manufacturers end up making, they will be able to sell it. There's no question of whether or not they will be able to sell it. It's just a question of will they be able to sell it if these jurisdictions end up legalizing it. But like I said many times before, with these brand new industries, there's always going to be challenges that you can't really foresee. And that's part of the risk you take on investing in a brand new industry is there just being risks that come up that you just haven't been able to foresee. And the issue that was faced here in Canada, at least, which has proven to be very difficult for Canopy in particular to overcome, has been overproduction. They just plain simply overestimated how big the industry was going to be. And because they were receiving so much money from investors back in 2018 and into 2019 through stock issuances because their share price was so high, they had all this money that they could put into production. They ramped up production so much that they just made so much weed, and they are having trouble selling it to actual retailers out there. And this goes back to my point I made earlier. When investors are presented with a new opportunity, a brand new industry, they have a tendency to be very optimistic towards the future of that industry, to the point where they fail to foresee the challenges that may come. And foreseeing the challenges that may come in any industry is difficult, not just with weed, but any industry. And I'm not saying that every investor out there should have seen this coming, but what investors can do is look at the market cap of the company when they're thinking of making an investment decision, perform an analysis to determine what future scenarios of revenue, earnings, and free cash flow are priced into that market cap. So then you can make a decision for yourself and say, is it actually reasonable to assume that this company is worth what the market has quoted it as? So now let's try and analyze Canopy Growth as if we're at the absolute peak of the green rush. So all your friends just made a ton of money on Canopy Growth stock. They're telling you to get in now because it's amazing, it's the best thing ever, and you're going to make tons of money. And it's currently a $12 billion company. So you, being a rational investor, are trying to determine, is it actually reasonable to buy this stock at its current price? Let's just do a very, very, very basic analysis and see if it actually makes sense. So we'll assume it's kind of early 2019. So the sales for the year end of 2019 was about $226 million. Now we're just going to take free cash flow and we're going to assume that they became free cash flow positive right at their year end of 2019. We obviously know that that wasn't the case. In fact, it's quite the opposite, but let's just assume you didn't know that was the case, that was going to be the case back then. So you just wanted to assume this company was going to make free cash flow, which ultimately, that's, as we discussed before, that's why any investment has any value. I mean, when you see a market cap of $20 billion, what the market is essentially telling you is that it thinks that from now until the end of time, all the future cash flows that this business will generate, discounted to the present value at whatever discount rate you want to use, is worth $20 billion. So if you think it's going to be higher than that, you'd invest in it. But if you think it's going to be lower, then you would avoid it. So let's take a look here. So I basically just grew revenue at 40% a year. Again, we're just assuming that you haven't done a ton of research on this company. You just want to get an idea of if $20 billion is reasonable. So you're going to say sales grow at 40% a year. Maybe it's too high, maybe it's too low, but let's just keep that assumption in for now. And free cash flow will be 5% of revenue. Again, this is super, super simplified, really just doing this to kind of make a point here. So 5%, and then it grows by 1% every year, because as businesses get bigger, they achieve economies of scale and they can become increasingly free cash flow positive. So free cash flow is going to grow in terms of the percentage of sales, and it's going to grow along with sales as the business itself grows. And then we'll take a 25 terminal value. So at the end of 2028, so within 10 years, the terminal value you're going to assume that those free cash flows will have is 25, because it's really difficult to project free cash flows beyond 10 years. You really shouldn't go anything further than 10 years. So 25 is quite a high terminal value to use if you're just doing a very basic free cash flow model here. And then you're going to take the present value and you're going to use a 15% discount rate. Now you're using 15% because you want to make sure that you outperform the market by taking on the additional risk of investing in a company like this. And because it's such a new industry, it's more risky. So you want at least 15% return. So you do all that, you sum up all the cash flows that we've calculated here, including the terminal value, and you only get $5.3 billion. That is significantly lower than what the market cap is. So just with some basic calculations, you were able to determine that what the business is telling you or what the market is telling you. Let's say the business is worth $20 billion, but with just some basic assumptions here, which do seem quite optimistic, you're only calculating it to be worth $5.3 billion. Now, let's say you have a better understanding of this company and you think that they're going to grow sales at, say, 60% a year. So you do 60% a year. That is very, very high sales growth to achieve for that long. That means in 2028, they're going to be doing about $15 billion in sales. That is quite a big company. For a company to go to 220 million to 15.5 billion, that's very optimistic. But I mean, everyone's telling you the weed industry is the next great thing, so you go along with it. Even with that, if we keep our free cash flow assumptions the same, even with that, the future stream of free cash flows that you're projecting this business to generate is currently below the market cap. That does not indicate a good buying opportunity. Assuming, again, you want 15% return. If you're okay with 10%, then at 10% it makes sense. But you can get 10% by just putting your money into index funds and leaving it there for a long period of time. If you're going to invest in an individual company, you're going to want a higher return because you're taking on more risk. So really, it makes more sense to use 15%. So you can kind of understand, again, this is super, super simplified, but you get an idea of how you could look at companies reasonably, because over the long term, companies will fluctuate, their stock price will reflect the actual fundamentals of the business. In the short term, it just depends on social media trends, news, investor sentiment, but over the long term, it's going to depend on actual fundamentals. So those very lofty expectations that we just did in our analysis of Canopy, again, going back to as if it was early 2019 or late 2018, are not what actually ended up happening. Here's what actually ended up happening. They've lost quite a bit of money. They're losing billions and billions of dollars every year. And as I discussed before, the reasons for this were because, one, of overproduction. I mean, they just made too much weed and they've just flushed the market with too much weed. They couldn't actually end up selling it, which results in having very high inventory, and carrying inventory is quite expensive. And it's even worse if you can't actually end up selling that inventory, then that destroys a lot of value in the company, which is not a good thing. And investors were using this metric called funded capacity in the early stages of weed stocks. And they were using it because they wanted to know how much capacity could these weed companies actually end up producing, because it wasn't a question of whether or not the weed would sell. That was assumed to already be true. It was really just a question of which company has the ability to make the most weed, because inevitably once these jurisdictions legalize it, they will be able to sell it. But that wasn't ultimately what ended up happening. So what can be learned from this? Why did I make this video? Well, really, it's just to show you guys that doing your homework and actually valuing companies, even if it's just something super, super simple, is a very powerful tool. It's, in my opinion, the best tool that retail investors have available to them, because it can really help you understand and make sense of what's going on in the broader stock market. And it can really help protect you against irrational speculation and not getting caught up in these hype trains that put you at risk of losing your hard-earned money. And it just takes a little bit of knowledge, right? It's not something that's super complicated to do. Just with a little bit of training, anyone can learn to do it. And I know I did kind of pick on Canopy in this video, and I did that really just because they're one of the more notable ones. It wasn't just Canopy that faced these issues, really. It was most of the larger weed manufacturers out there. And what's also worth mentioning is that in spite of this company's very rough history and uncertain outlook, it's not over for them. They still have a real opportunity to capture significant market share in the weed industry. And although it is facing its challenges, such as overproduction, they do have the ability to ramp up their production if demand increases. For example, we go up here, we can see their PP&E account, so property, plant, and equipment, is valued at over $1 billion. That means they have a ton of equipment ready to produce weed if the demand shows. They also have over $1 billion in cash and over $1 billion in short-term investments, which could easily be converted into cash. So they have the ability to make acquisitions, which could help them grow the business. And if the weed industry does turn around and it takes off like a lot of people expect it to, Canopy is a company that would vastly benefit from that. So anyways, guys, thank you so much for listening to this video. I hope you did find it useful. If you did, then please leave it a like and subscribe if you're new to the channel and you enjoy this type of content. And I'll see you in the next video.